The debt ceiling is often presented to the public as a last line of defense against reckless government spending, a symbolic red line meant to force discipline on a system addicted to deficits. But in truth, it has always been a farce, an illusion of restraint maintained for appearances while the real machinery of debt expansion rolls on undisturbed. Congress passes budgets that require borrowing, authorizes entitlement programs, approves military interventions, and signs off on multi-trillion-dollar spending packages, only to later pretend surprise when the bill comes due. The ceiling doesn't control spending, it merely delays the legal authority to finance what has already been approved. And when the time comes to reconcile that contradiction, the result is never austerity or reduction. It's a ritual of brinkmanship. For weeks, headlines warn of defaults. Credit rating agencies issue thinly veiled threats. Markets flutter, lawmakers posture, and late-night meetings produce urgent compromises. Yet, despite the breathless theatrics, the ending is always the same. The ceiling is lifted, the Treasury resumes borrowing, and the debt curve bends upward as it always has. The restraint never holds because it was never designed to. It is a legal fiction that allows politicians to claim fiscal responsibility while ensuring that the spigot of credit remains wide open. And for those closest to the flow of that credit, banks, asset managers, bond traders, the standoff is not a threat, it's a known variable, a well-understood pattern that can be gamed for profit. Treasury auctions resume with renewed vigor, yields adjust. Derivatives tied to U.S. sovereign credit experience bursts of volatility, ideal for those who position themselves in advance. Like clockwork, the crisis feeds the very institutions it supposedly threatens. Worse, the illusion of restraint gives cover to the idea that someone, somewhere, is in control. That this is all part of a careful balancing act between fiscal prudence and economic necessity. But there is no balance and there is no control. The entire structure is built on forward motion, on the guarantee that debt will always grow, that ceilings will always rise, and that the illusion will be preserved just long enough to prevent the public from realizing they're watching the same play unfold again and again. In the rare moments when the ceiling does bite, such as temporary freezes on federal salaries or program delays, it's the citizen, not the banker, who feels the pain. Wall Street has already accounted for the outcome. The ceiling debate is noise. The Treasury market is signal. And that signal is clear. America will always borrow more because it must, because the system now depends on it. The restraint is a myth. The ceiling is a prop. And the real decisions about debt are made long before the drama begins, by committees, institutions, and financial structures whose profits swell with every act of this endless performance. When the debt ceiling breaks, it doesn't just authorize new government borrowing, it initiates a feeding frenzy. Within days, the U.S. Treasury begins issuing massive waves of bonds to refill its depleted coffers. These bonds don't linger in bureaucratic limbo, they're devoured almost instantly by a financial system built to extract value from every new dollar of public debt. Primary dealers take first bite, buying directly from the Treasury and flipping bonds into the secondary market for predictable gains. Large commercial banks use the securities as zero-risk collateral, multiplying them into loans and derivatives through the repo market. Pension funds and insurance companies treat them as essential ballast, required by law and regulation to hold massive quantities of safe government debt. Foreign central banks, particularly those in export-driven economies, accumulate treasuries to keep their currencies weak and their trade surpluses high. And then there's the Federal Reserve, hovering above the entire system like an invisible hand. Through open market operations, the Fed purchases enormous volumes of these securities, injecting synthetic liquidity into the banking system. This new money doesn't trickle down into local businesses or wages, it flows directly into financial assets, stocks, corporate bonds, real estate, raising prices, rewarding speculation, and enriching those who own the most. It's no coincidence that every post-ceiling raise cycle in the past 2 decades has been followed by an asset boom. In 2011, markets surged after S&P downgraded U.S. credit. In 2013, they hit new highs amid fiscal cliffs and continuing resolutions. In 2021, record debt fueled record liquidity, and tech valuations soared to unsustainable peaks. The public narrative frames these episodes as narrow escapes from fiscal disaster. But for the elite asset holders and institutional investors positioned in advance, they are windfalls. The more urgent the crisis, the more violent the relief rally. And the more bonds issued, the more collateral there is to support leveraged trades that magnify returns. This is the mechanics of profit in the modern debt economy. Borrow from the future, sell to the present, and let the central bank ensure prices rise faster than inflation eats the gains. Meanwhile, the taxpayer absorbs the interest, the worker absorbs the inflation, and the saver absorbs the dilution of monetary value. Debt ceiling breaches do not destabilize this system. They are the fuel that keeps it running. Each new round of bonds tightens the golden chain between public obligation and private gain. The government borrows more, but it does so in a way that systematically favors capital over labor, rent seeking over production, and institutional advantage over individual opportunity. The winners are not the voters, not the retirees, not the families promised prosperity through responsible governance. The winners are those who understand that every ceiling is an invitation, every crisis a setup, and every treasury bond a key to a vault only they hold. Behind every debt ceiling standoff, past the televised speeches and political brinkmanship, operates a silent partnership that ensures the real consequences are neither default nor disaster, but acceleration. The U.S. Treasury may control the issuance of debt, but it is the Federal Reserve that ensures that debt finds a home and that liquidity flows where it's needed most. When the ceiling is raised and new bonds flood the market, the Fed doesn't wait on the sidelines. It acts in lockstep. Interest rates are nudged to calibrate demand. Reverse repos are adjusted to absorb excess cash. And when needed, the Fed resumes or expands its balance sheet through open market purchases of treasuries, directly injecting reserves into the banking system. This coordination isn't formalized in law, but it's deeply embedded in practice. The Treasury issues debt. The Fed absorbs it, directly or indirectly. The result is a seamless pipeline of capital from public obligation to private balance sheet that turns every debt ceiling breach into a moment of structural reinforcement. The liquidity created in this process doesn't flow randomly. It channels directly into the institutions positioned to receive and deploy it first. Systemically important banks, hedge funds, money market funds, and major asset managers. These entities do not simply buy bonds, they use them as collateral, as leverage, as instruments in complex derivative chains that expand monetary influence far beyond the original transaction. The average citizen sees headlines about trillions in borrowing and imagines future tax hikes or cuts to public services. But inside the Fed's system, each dollar of new debt is another building block in a towering structure of liquidity, risk, and return. The ceiling, therefore, becomes something far stranger than a fiscal limit. It functions as a timed release valve, a mechanism to synchronize political theater with monetary expansion. And when the Fed steps in to stabilize markets, it is not saving the economy from dysfunction. It is sustaining a monetary architecture that requires constant expansion to avoid collapse. This is the hidden engine behind what seems like chaos, a debt machine that relies on the central bank not as a last resort, but as an active participant in the dance. The illusion of separation between Treasury and Fed is a relic of a time when monetary policy was supposedly apolitical. Today, the coordination is precise, predictive, and quietly acknowledged by those who benefit most. When the ceiling breaks, the Fed ensures that no one who matters gets hurt. Liquidity is directed, risk is socialized, and the monetary base expands in perfect rhythm with the fiscal illusion of restraint. The ceiling was never meant to stop debt. It was meant to time its release, just as the Fed was never meant to dictate fiscal outcomes, but now does so with every keystroke on a Bloomberg terminal. What appears to be a crisis is in fact a carefully choreographed expansion, engineered to reward those at the source while leaving the consequences for everyone else. In 2008, the U.S. faced what was publicly framed as a once-in-a-century financial collapse. But for those who understood the architecture of debt, it was something else entirely, a generational opportunity. The collapse of Lehman Brothers, the freezing of credit markets, and the implosion of toxic derivatives did not signal the end of the system. They signaled its mutation. Within weeks, the debt ceiling was lifted, TARP was passed, and the Treasury was authorized to issue hundreds of billions in new debt, ostensibly to save the economy. But the funds didn't flow into households or small businesses. They flowed into balance sheets, those of AIG, Citigroup, JP Morgan, and BlackRock. Toxic assets were bought at par, liabilities absorbed by the public, and the cost of failure erased by legislative fiat. As the debt ceiling expanded, so too did the reach of the financial sector, with the Federal Reserve acting as both buyer of last resort and enabler of limitless leverage. By 2010, Wall Street bonuses were back to pre-crisis highs, while Main Street slogged through record foreclosures and a jobless recovery. Then came 2020, and with it, a new flavor of crisis, viral, global, and total. But once again, the pattern held. Markets plunged, panic spread, and within days the ceiling was raised in practice, if not immediately in law. Congress passed multi-trillion-dollar relief packages, and the Treasury issued a tsunami of new bonds. The Federal Reserve committed to buying them in unlimited quantities, launching asset purchase programs that included not only treasuries and mortgage-backed securities, but, for the first time, corporate bonds and even high-yield junk. Private equity firms received government-backed loans through PPP structures they helped design. Hedge funds captured spreads from dislocated credit markets, knowing the Fed would catch every fall. Tech giants watched their valuations triple as excess liquidity chased growth at any cost. And through it all, public debt soared past $30 trillion with no mechanism nor political will to reverse the course. In both 2008 and 2020, the debt ceiling became less of a brake and more of a lever, pulled swiftly in response to systemic shock. But instead of leveling the economy, it tilted it further, concentrating wealth, increasing dependence on asset inflation, and tethering government survival to the health of financial markets. The narrative was rescue. The reality was transfer. Trillions in future obligations were piled onto the public ledger to backstop the portfolios of those already closest to the monetary spigot. Crisis did not shrink the system, it supercharged it. And each time the ceiling played its role, not as a warning, but as a trapdoor. What was once a constitutional constraint became a conduit of consolidation. The beneficiaries weren't teachers, truck drivers, or small manufacturers. They were asset managers, megabanks, and firms that extracted more from markets in a week than most Americans earn in a lifetime. This wasn't failure, it was blueprint. The debt ceiling, far from being a relic of fiscal responsibility, had become a precision instrument of elite advantage, deployed in moments of maximum fear to generate maximum profit. As every debt ceiling standoff unfolds, the media fixates on the apparent chaos, late-night negotiations, partisan brinkmanship, and dire warnings of imminent default. But while cable news dramatizes every twist, the financial system exhibits a strange calm, an eerie confidence that the outcome is never truly in doubt. Traders don't panic, credit default swaps barely move. Treasury auctions continue without interruption. The reason is simple, the game is fixed, and the players with the most at stake know the rules. Wall Street has learned to ignore the headlines and follow the script. Every debt ceiling debate is political theater for public consumption. But behind closed doors, the machinery of debt expansion grinds forward with the precision of a seasoned bureaucracy. Lobbyists working on behalf of major financial institutions swarm Capitol Hill in the weeks leading up to each crisis, not to prevent the breach, but to ensure that any resolution includes the right terms, no technical default, no prioritization of payments, no withholding of interest due. They understand that Treasury securities aren't just government promises, they're the foundation of trillions in global financial contracts. A true default would be catastrophic not for the government, but for the system that monetizes its obligations. That's why it's never allowed to happen. Politicians may grandstand on cable news about runaway debt and generational theft, but behind the cameras, they negotiate with remarkable precision, making sure the ceiling is lifted just in time to avoid any actual consequences. The delay itself becomes part of the pattern, generating headlines, shaping public opinion, and creating market volatility for those positioned to benefit from it. In this sense, the entire process is gamified. Insiders can bet on Treasury yield spikes, volatility indices, or sector-specific trades with the confidence that Congress will eventually capitulate. The illusion of uncertainty creates real opportunity. Meanwhile, retail investors, retirees, and average taxpayers are left to absorb the noise, unaware that the outcome was never in doubt. Even federal agencies prepare for ceiling breaches with scripts and contingency plans that assume, at worst, a brief disruption before normal operations resume. No one inside the system truly believes the U.S. will default, because the architecture of the financial world cannot function without continuous, uninterrupted expansion of American debt, and so the dance continues. Politicians pretend to fight. Markets pretend to worry, and the debt grows, quietly, predictably, inexorably. The ceiling is raised, portfolios rise with it, and another layer of complexity is added to a system whose primary output is no longer production, but leverage. For those who understand the choreography, each crisis is a trading window, each compromise a windfall. The true risk lies not in the breach, but in the illusion that something might change. Because the moment anyone seriously questions the certainty of ceiling increases, the entire edifice, built on the assumption of infinite borrowing, would begin to crack. But until then, the show goes on, and the script, though dramatic, never deviates. For every trillion-dollar breach of the debt ceiling, for every round of Treasury auctions and Federal Reserve liquidity injections, a corresponding cost is quietly imposed, not on the financiers who profit from the cycle, but on the citizens who unknowingly subsidize it. The hidden toll begins with inflation, a slow erosion of purchasing power that strikes hardest at those without assets. As the monetary base expands to absorb new debt, the value of the dollar declines, pushing prices higher across housing, food, fuel, and essentials. While the headlines attribute these increases to supply shocks or global factors, the truth is structural. A system that continuously issues debt and monetizes it through central bank intervention necessarily debases the currency over time. Those holding stocks, bonds, and real estate see nominal gains, but those holding cash, fixed wages, or retirement savings see erosion. A family earning $60,000 a year loses ground with every round of stimulus that inflates asset bubbles, but leaves wages flat. Meanwhile, the national debt now surpasses $33 trillion, and with each new ceiling raise, more of the federal budget is devoted not to education, infrastructure, or healthcare, but to interest payments. Servicing the debt absorbs hundreds of billions annually, and rising rates mean this burden only grows. Future generations are conscripted into fiscal servitude, taxed not for prosperity, but for the maintenance of a debt architecture that serves a shrinking elite. Social programs are quietly squeezed. COLA adjustments fail to keep up with real costs, and workers are told to be grateful for stagnant jobs in a resilient economy defined by asset inflation and consumer debt. Beneath it all, dependence deepens. Cities, states, and pension systems now rely on high asset valuations to remain solvent. Households rely on low interest rates to afford mortgages, student loans, and auto payments. Markets rely on central bank liquidity to maintain stability. The entire system floats on a sea of credit that expands with every ceiling breach, and yet the risks are borne by those least able to navigate them. When markets wobble, the response is always the same: print, borrow, expand, and each time the costs are diffused into the economy in invisible ways, through higher prices, reduced opportunity, and a growing sense that the future is slipping out of reach. What was once a temporary emergency measure has become permanent economic governance. The debt ceiling doesn't prevent crisis, it institutionalizes it, channeling its rewards to the top while socializing its consequences. The American dream, once built on productivity and savings, has been recast as a financial illusion, maintained by perpetual borrowing, and as that illusion grows larger, the system requires ever more debt to keep it alive. In the end, it's not the ceiling that breaks, it's the contract between citizens and the institutions that promise to serve them, replaced by a silent arrangement in which their wealth is drained, their choices narrowed, and their futures mortgaged for someone else's return. By the final act, the true nature of the debt ceiling reveals itself, not as a stop sign, but as the linchpin of a system that only survives by accelerating forward. What began in 1917 as a political innovation, meant to ease wartime borrowing and create a public facade of restraint, has become the central pillar of a financial architecture defined not by discipline, but by dependence. Today, the U.S. economy is woven around the perpetual expansion of public debt, with each ceiling breach reaffirming a deep institutional truth. America's prosperity is now underwritten by its willingness to borrow and its power to monetize that debt through the world's most trusted printing press. No major crisis, from war to pandemic to financial collapse, has ever resulted in meaningful fiscal contraction. Instead, every emergency becomes justification for another expansion, another ritual raising of the ceiling, another transfer of future claims to present beneficiaries. This is not failure, it is design. The ceiling's periodic drama is the necessary spectacle, the smoke and mirrors that transforms public anxiety into private gain. Legislators posture, journalists warn, markets flutter, and the insiders prepare, knowing each round will deliver fresh collateral, fresh liquidity, and fresh opportunities for profit. Debt, once feared as a threat to national stability, is now the very foundation of market confidence. Treasury bonds are not just obligations, they are currency, reserve, and leverage. They are the asset of choice for banks, the safe haven for institutions, the engine behind global capital flows. The debate over the ceiling is no longer about limits, it is about timing, about how quickly, how often, and under what narrative the next flood of debt can be unleashed. The question is never, will we breach the ceiling, but who stands to gain when we do? Because each cycle widens the chasm between those who collect interest and those who pay it, between those who trade in anticipation and those who are left with the bill. The ceiling is not an emergency brake. It is a toll booth, a mechanism for extracting rent from the public purse and concentrating it in the hands of those who own the system's infrastructure. Debt has ceased to be a warning. It is the oxygen of a financial order that cannot function without it, the indispensable fuel for markets that have long since untethered themselves from production or savings. The system will not stop. It cannot afford to. The ritual will repeat, louder, faster, higher. And the only certainty is that when the next ceiling breaks, those who profit will have already placed their bets. For everyone else, there will be new headlines, new promises, and new debts, layered, as always, upon the silent architecture that makes the whole illusion possible.